Assalamu alaikum and welcome back to the channel. As many of you will know, my day job is at Cur8 Capital, helping to manage over $100 million of investments for some of the most affluent investors across the world. Naturally, when you are in this job, you end up getting the inside track on so many of the economic and investment trends before anyone else does. And it is my job to use that information and make our investors as much money as possible. But by far the biggest asset class out there is property. And today we're going to talk about that. Where we think from a UK lens, but also generally from a Western lens, where we think house prices are headed, why I'm personally going to be moving city, where I'm going to be moving to, and I'll also trailer where Cur8 Capital will be positioning its investments and its approach to these trends as well. In order to take advantage of house price movements, which is buying low and selling high, we first need to understand what makes a house price increase or decrease. Now, there's a conventional understanding that when interest rates go up, house prices should fall. However, as we can clearly see in these graphs, house prices are not really strongly linked at all to interest rates. The reality is that there are three things that affect house prices: supply and demand, interest rates, and money supply. You see, supply and demand we know has historically supported house prices because there simply isn't enough supply and there is a lot of demand. This should be pretty obvious to us all just by looking at the amount of people who are renting and struggling to even find a place when they're trying to rent, let alone the amount of people who are keen to get onto the housing ladder but struggling to get on to the housing ladder. There is a lot of demand. Interest rates we've already discussed. They've ramped up a lot over the last year or two. House prices haven't really fallen though. They've fallen a little bit, but not too much. And now interest rates are expected to gently head downwards. So again, this should help house prices, if anything. Now, money supply is the third factor, and it is the critical factor here, because over the last 15 years, we have seen an enormous injection of capital into the economy. I mean, just look at this graph. This is an absolute mountain of money that has entered the economy. And then COVID came along, and another mountain of money entered the economy again, thanks to the government's quantitative easing policy. The critical question is, how did that money enter the economy and who owns that money right now? Well, the government printed money and it bought back bonds that it had issued from insurance companies or pension funds or banks. And the net effect of all of this was a load of money got given to people who were holding these assets, and it ended up with institutions, banks, and rich people, i.e. those people who were closest to the money printing machine. This is a critical point. Money doesn't disappear. Someone ends up owning it. It is always the people with the assets. Now, what the government expects to happen when it gives all this money out is that it will reduce interest rates, stimulate the economy, and the banks and rich folks will start spending. But that didn't really happen because interest rates were high. So the banks and all of the rich folks were just very happy to hold the cash and make a risk-free interest return on it. So in the short run, money, which now does exist, doesn't actually enter the market and increase house prices, as the money is just sat in a savings account. But now, all that is about to change. The UK money supply, i.e. the money that is actually in the economy, started falling for the first time in years into negative late in 2023, as this graph shows. This is because interest rates have soaked up all that extra money and taken it out of the economy. But we're now getting to that critical stage where the Bank of England and the Fed are signaling that rate cuts are on their way because they want to encourage some of that savings account money out into the playground again. And this means the rich and the bankers don't get as much money for doing nothing in the savings account anymore because interest rates have fallen. So they're going to start shifting this almighty arsenal of money that we saw earlier being printed, that they are sat on, into the usual stuff they put their money into, which is property and businesses. Or in other words, the real estate market, stocks and shares, and private equity. So all of that is a really long way of saying that I think the property market is going to start growing again, and growing pretty aggressively over the next few years. And note, this is not a moral comment on this phenomenon, because I think that the way that our system is set up right now is going to only increase the inequality between the haves and the have-nots, and that is going to ultimately end up with us as a country and us as a Western civilization ending up in a pretty difficult place politically and where power lies. Look, this new phase of the economy is going to create new millionaires and billionaires, and it will be people who are holding assets, stocks, property and private equity who are going to win. We, for the purposes of this video, are focused on just property, but we may do other videos in the future on some of those other areas as well. The first and obvious thing to say is that if you are not on the property ladder, try your utmost to get onto it. The game is rigged, ladies and gentlemen, and it benefits those with assets. This could well be the last time you are able to even afford to buy yourself a house in any of the major cities of the UK, because what happened to London is now going to happen everywhere, and this graph shows this clearly. The fastest growing house prices in the country are not London. They are all these other nice cities that people like and are considering moving to and actively moving to. And this, of course, is partly the COVID effect, where remote work became normal and folks realized that they can work from anywhere and have a much better quality of life as well. Let's look at Birmingham in particular. A house in Birmingham would cost you about 50k back in the day, but now it costs you a minimum of 250,000. And my bet is that house prices are going to rise everywhere, but they are going to rise disproportionately fast in the top 10 or so cities outside of London in the UK. Why do I think that? Because I think folks who are looking to buy will disproportionately focus on the cheaper section of the market that is more affordable because they get more bang for their buck, and because remote working allows them to do that for the first time. Before, they just wouldn't have that opportunity and they were much more focused around London and the south. So my conclusion is to buy property and to buy it anywhere in the top 10 of this list. Don't get me wrong, I'm still very bullish on London when it comes to serviced accommodation and other rental market players like HMOs and blocks of flats, etc. London is a hub and always will be, and folks will need to travel there regularly. Indeed, many of our team, and once I move out, I will have to do this as well. And I know for a fact that when I come to London, I will be a regular user of serviced accommodation and Airbnbs and HMOs. I am inshallah moving to Manchester, which is one of the top 5 cities on that list. I'm moving there because it's got excellent transport links to London and I will need to commute in regularly, and because my parents and in-laws are living there or near there as well. If I save up more personally and want to allocate that to property, I will be investing it in flats and other rental assets in and around Manchester, Birmingham and London. The thesis is that these assets will give me a nice yield and also appreciate over time, because there will be a fundamental lack of supply regardless. Even if we ramp up very fast, it will still be something that appreciates in value over time. Okay, now moving on to how Cur8 will play this. Well, I previously already done a video on the mega trends we are focused on as an investment house, which will inform our investment strategies. But specifically revisiting property, the key themes and areas we want to exploit are: first, serviced accommodation and blocks of flats. Our marquee fund, in partnership with Rosmala Bank and Viridian Apartments, does exactly this. Viridian Apartments is very much focused on this niche, and we continue to double down on this area. Second, property development. We have invested in this area through bridge financing type deals, but also where we are partnering up with managers who are seeking planning permission on certain plots of land that then increase in value once they have planning. But this is an area where I personally believe we are a little bit light on, and I would like to increase our exposure with the right partners to further property development projects all over the country, particularly in some of the larger cities. I also believe that certain developers in the market have overstretched themselves, as they had been set up for a different area with much lower rates, and they are now running into some difficulty. So there are strong opportunities to pick up some bargains from people who are making distressed sales. And long term, there are strong margins to be made in this sector, because if we are correct, the house prices will rise and housing demand will remain very strong, then the exit is pretty clear too. You just sell it to people who want to buy houses. And as interest rates start falling, you would expect that more and more people are able to afford houses because they will be able to afford mortgages. That's it for today, folks. I would love to hear from you in the comments below about how your city is performing, whether you're going to be buying property, and if you are, where you're going to be buying. Do you agree with my overall analysis? And do you think I should be moving to Manchester? Am I making a mistake? As ever, like this video, subscribe to the channel and share it with your friends and family. Until next time, Assalamu alaikum.